We have Deepak Shenoy joining us to talk to us about just that. Deepak, what do you make of the market texture? Do you think this consolidation and sideways moves will likely continue?
It's only been sideways, I think, a couple of days. That broad market, of course, has been, broader. The broader market, like the Nifty 50, I think, has been kind of consolidating. But we've seen the mid caps and small caps go up quite a bit last month. So there's a normal kind of a correction that seems to be coming. It's not even a correction; it's just about 3-4% off the top. So I'd say you want such times just to kind of even out the over ebullient types where you want to kind of balance things out. But I think yes, there's some froth that was there in some of the stocks that has probably corrected a little bit. We're expecting a little more, but that's just part of the game. If you don't have these times, how are you going to have the good times?
The portfolios seem to be bleeding a lot more because the small cap index, for instance, has had the biggest intraday fall since December 2023. So, I mean, of course, a month, but then nonetheless, there are sharper falls, is what I'm saying, in the broader markets, and individual names knocks anywhere between 15 to 20% on obviously public sector entities. And yes, they had gained that much as well. But which are the pockets, Deepak, where you would sense a bit of an over exuberance and suggest people to book profits?
I can't suggest people book profits. I don't think we can give any advice on this. But in general, we're seeing, okay, some parts, perhaps the PSU universe got a little excited, but I think there's a lot of value there as well. A lot of stocks are still trading at single digit price to earnings ratios with lots of growth ahead. So I think this correction is kind of more relative to recent moves rather than to anything more long term in nature. There's also, in stocks, certain chemical stocks, for instance, there's been a disappointment in results. We're seeing that play out in stock prices as well. In other cases, in some banks, we've seen banks being weak earlier. I don't know if banks are weak, overall today, but I know that there is possibly some correction that should happen in NBFCs because there's a fundamental change over there. RBI has gotten quite serious about regulation. There was a speech by an RBI deputy governor. I think Friday it was on their website, which talked quite seriously about how they're looking closely at microfinance, at P2P players, at a bunch of other NBFCs as well. So we should expect more regulatory overhang. So some part of that correction is justified there. Overall, I would not say book profits or anything like that. I think all market times will show you opportunities to both enter and exit on a stock by stock basis. So you've got to make the calls based on your portfolio.
Deepak, still sticking by with Paytm. The latest that we're picking up is that the Kirana Club report, which is claiming that 42% of Paytm merchants are looking for other partners. The company, it seems, is making all its efforts. There is no such disruption in the pipeline.
So we can't comment on Paytm, unfortunately, Ayesha. We have a conflict, so nothing on the stock. I hope the whatever resolution happens soon and people are not inconvenienced as a result of this. I hope everybody, including the regulators, are cognizant this is a large payments bank that they're talking about. But again, no comments on the stock. I have at some point, but we'll have to figure out when because much of the whatever the fundamentals were have not yet reflected in their numbers. It will happen a year down the line. So you may take a long time before the stocks turn around, or it may just start to move again in a couple of weeks. But I mean, I remain positive about the future. We've actually curtailed our position a little bit in some of these stocks because they'd become too big as part of our portfolios. But we continue to hold some of them because the longer term potential is still quite a lot higher. So I think you'll have to take a call on this on an individual basis. But some stocks, for instance, some stocks are pure momentum, and you have to play them as momentum per se, which means you get into them when they're going up and you get out of them when they're going down. That's just how the business works. But if you're not playing them for that and playing for fundamentals, I think some of the fundamentals remain very, very strong. So a longer term thought process may still be useful for some of these companies. I'm not taking names. We're still in the process of continuing to buy or add to more to some of them.
So we'd love to hear those names in the next conversation. But in the meantime, let me go across to Sharad to get a sense as to what the cover is on Dalal Street, because there seems like there's a lot of buzz around cement sector, and Sharad has picked out one such cement company which is seeing a lot of action. Sharad, tell us more.
Well, we have been talking with the dealers, and there is a carnage for the second straight session when it comes to the mid caps, small caps, and even PSU names. But there is one stock where there is a buying happening, especially from a long only fund, and that is Star Cement over here. Of course, the volumes have also picked up 13 times its 20-day average, and the stock itself has seen its biggest intraday jump over the last 2 months. Now, importantly, if you look at it, the DI is already invested in the company, includes the name of SBI Mutual Fund having roughly 6% stake in the company. Recently, company came out with its Q3 numbers which were above the street estimates, and importantly, the clinker and the grinder capacity, those additions will be happening in the current quarter, which is the fourth quarter, and importantly, the plant incentive and cost optimization is expected to increase the EBITDA per ton going ahead as per the analysts. And also importantly, the cement demand as per our channel checks has been stable in the north, east as well as the eastern markets. And also importantly, the FY24 volume growth guidance that stands at roughly 9 to 10%. Earlier that guidance was between 11 to 12%. So long only fund buying is happening as per the channel checks when it comes to Star Cement.
Okay, let's check in on what some of the other buzzers are in trade. And on the downside, clearly it's Bharat Forge. You can't take your eyes off of this one, 11%. But in the meantime, not just Bharat Forge, but a Hindustan Copper that's fallen about almost 10%. There's Nalco as well, which has seen a near 9% slide. There's Bandhan Bank, which is down about almost 7%. MCX is down quite a fair bit, 8.5%. And of course, within the index movers, besides bank like an IndusInd, which is fallen sharply about 2.5% in Hero MotoCorp, there's BPCL and ONGC, which are seeing a sharp slide. Now, Kunal, this also comes on the back of acute outperformance from the entire OMC pack and ONGC put together. You think the dips are going to get arrested and bought into soon?
Not so for the OMC. In fact, for the OMCs, I would actually believe that these stocks should be good for at least another 10 to 15% correction, individually, because the likes of IOC, for example, was very close towards breaking the 200 mark. I think 196.98 was the high for the stock. Currently, it's at 174. The 50 DMA, for example, for the stock is still at 138, and the 200-day moving average is at 103, 104 for IOC, which means that the stock had diverged from its long-term moving average by a margin of more than 90 to 95%. These are very steep divergences for typically low beta stocks like the OMCs, and I believe that when such kind of divergences, when they correct themselves, these stocks, they tend to get into a mean reversion phase for at least a 50-day moving average, if not more, which means I would expect these stocks to correct and come back towards, say, 145 to 150 mark for IOC, and similar kind of a percentage correction for the other two names, BPCL as well as HPCL.
In fact, we spoke with a whole host of these earnings managements, the likes of Paris Defense, Bandhan Bank, etc. Let's hear out the sound bites post their earnings.
We would want to keep a steady 2x or 2.5x of your revenues. So this is on schedule. The higher growth will come in the fourth quarter, and it should with a tolerance of 5-10% here and there, but it should be on schedule.
Tight liquidity situation, cost of fund has increased across the all banks, and that is then impacted to the NIM. So we, after that also, if you see, our NIM is a 7.2%. We are continued the last 2 quarters. So we feel that as per our guidance, this financial year 7 to 7.5% will be like to see that we can be managed in that.
Domestic segment is growing faster than the exports currently. We are estimating about 30% growth in domestic revenue and about 10 to 15% growth in the export revenue.
The gross margin has substantially improved. We are currently at around the new segment, that is the retail. We have been opening stores. At the beginning of this quarter or the end of last quarter, we are already 140 stores. Retail stores. These are company-owned, company-operated exclusive outlets.
We feel that the margins-wise, we are good. Primarily, yes, on the demand side and the growth side. This quarter and the next quarter are looking like flattish growth. This year we should be ending up with a growth in the flat region. But if you look at the 25 onwards, we should see the growth coming back in the first half of 25 and should continue to see the growth journey from there on.
Okay, so that's the latest commentary coming in from a lot of these players as well, the earnings reaction that is. But taking stock of some of the other buzzers, Medanta is up around 5%, or Global Health as we call it. Zydus Life has continued to gain after that earnings and the buyback announcement. There was a con call, positive commentary coming in there. And then the entire pharma pack, whether it's a Divi's, whether it's an Aurobindo, other names as well, they're seeing quite a bit of traction. What's your take, Deepak, on the pharma pack, whether healthcare, whether these, CDMO players, etc.?
So healthcare went positive on some hospitals. That I think has been part of our theme for a while. We're positive on Narayana, not just because of their India business, but also because of the Cayman business, which we think will be quite significant in the overall scheme of things. Pharma not very keen on investing in it right now. Large amount of uncertainties arise. I think this year we will see a lot more FDA action as well. They haven't acted for their part of, maybe our momentum portfolios or something. But on a fundamental basis, I'm still not comfortable getting into pretty much most of the pharma pack. Perhaps later this year, we'll take a bigger call on it. Results have been quite decent, better than I thought they will be. I thought they'll be much worse. In some cases, they're actually super surprising on the upside. I would say that still I'll wait for a couple of quarters more before I see the response to FDA action, if any, and then take a call on them.
Okay. That's the take coming in on the overall pharma as well as the healthcare space. For the market, we are settling in lower by about 0.5% for sure. Barring those few dots of green, a large part of the market continues to reel under pressure. In fact, we're closing in on pretty much the session lows. On the brink of even reaching that 21,600 mark, which we may have already, 170 points lower, no less, for the Nifty spot, 21,677 for the Nifty futures. And today, it's really about the pain across the broader markets. I mean, not like we've not seen such days earlier. But yeah, it's the small as well as the mid caps which have fallen a lot more than what the benchmarks have actually done. Kunal, you think that may as a trend continue, that you see a steeper fall in mid and small caps because that's where the chunk of the profits are?
Yeah, it could be very much possible that the next couple of days, maybe the mid cap and small caps could actually fall a lot more because, these indices for the first time, I think, are going through a classical mean reversion. And, mean reversion is a very critical process for many of these asset classes which move up significantly higher. So after a stretch, I think if I'm not wrong, last year, same time in the month of Feb end, the mid cap index or the small cap index rather was almost at 8,000, and the recent high for the small cap index was almost 16,200, which means that in the last 1 year, you've actually seen these small cap indices double, but many of these small cap stocks have gone through quadruple or such kind of returns. Now, when these mean reversions happen, it's not a 1 day, 2 day, or 3 day process that these stocks would get into a correction and then the correction arrests after a fall of 10-15%. It's a process which takes place by for at least 1 to 3 months, and depending on the degree of mean reversion for themselves. So I think one should not be in a hurry to try and chip into these stocks just because they've corrected by a margin of 10-15%. I would believe that you could probably get better opportunities over the next couple of months.
Deepak, do you track Godfrey Phillips and of course ITC closely?
Godfrey Phillips, not so much. ITC, I think everybody tracks it in some way or the other.
Sure. So what's your view on that? ITC as well didn't point to a very big pickup.
Well, honestly, it's good for India if they don't sell tobacco quite much, honestly. But I think that's a cash business in the sense it generates cash. That cash is not going to grow at a meaningful rate. Growth is not going to come from tobacco. Say the primary business here is going to be FMCG. Hotels has been a cyclical in the last 20 years. This time the cycle has lasted much longer, and I think I think they've demerged or something like that on the hotels business, right? So there's possibly there is an ownership of the hotels business, but I think part of that gains will go to ITC Hotels shareholders, which is going to eventually get listed. But I feel here that FMCG is what their game is going to be going forward. The overhang on the stock is BAT's comments that they will sell or they will look to monetize stake. They own a significant percentage. ITC in general has been, in the last few years, has been a relatively low float stock because most of the float has been kind of held by long-term players, and therefore, pricing changes. There's not been much availability in that way. What used to be earlier the government threatening to sell stake through the SUTI route, now it's BAT threatening to sell stake. So I think for the near future, if you're looking at it as a 3-year or 4-year kind of process, I think this overhang will remain of just BAT selling shares. The company may do well on FMCG, but I don't think it'll get the FMCG valuations simply because some of the long-term holders want to sell, or one of the long-term holders wants to sell stake. So just a fair warning that float sometimes plays an abnormally high role in India.
About earnings, numbers from Mazgaon Dock were just out and they were flashing for you on the screen. The stock also reacted positively. One of those PSU names that actually managed to be in the green, and that's all on account of numbers because the profitability almost became 1.5 times on a year-on-year basis. So no surprise, the kind of reaction that we saw there. But on that note, Deepak, we'll let you go. Thanks so much for making time and speaking with us. Taking it across to Naresh to get a sense on Mazgaon Dock first, and secondly, your BTST ideas.
So still would be an avoid on all PSU names which have done really well. So would wait it out and avoid on Mazgaon. In terms of stock specific ideas, a long and a short, a buy on Tata Communications with a stop loss at 1720 and a target price of 1800. Second is a sell on DLF with a stop loss at 818 and a target price of 795.
What about you, Kunal? What's the BTST or STBT idea?
So I'll go with the large cap name, IT stock. HCL Tech as a buy. The stock looks attractive for a target of 1705. Stop loss at 1645, and the second would be a sell on India Cements. The stock has confirmed a break below its previous major swing support around the 240-44 mark. So keeping a stop loss of 242 would suggest a sell with a target of 228.
Okay, that's the latest STBT BTST ideas coming in from our technical experts. On that note, we let Naresh as well as Kunal go. Thanks so much for joining us, and we're ending the trading session pretty much in the red. That's how most of the day was, a 160-point cut. It was almost a cut of 700 to 800 points the last time I looked at that. So yes, that's the space which is coming under pressure, and your mid-cap index and small-cap indices are not far behind. There are deep cuts there. In fact, the mid-cap index down 2.5% and small-cap seeing a cut of almost 4%. Not really sure the last time we saw such a big cut. Of course, the advanced decline ratio then was favoring the declines. In fact, sectorally speaking also, it was only IT and Pharma that managed to held up in the green for most part of the day, because other than that, whether PSU banks, real estate, metals, they were all coming under pressure, and banks clearly were the key laggards. So all of those names were in the red. But that's how we're wrapping up Monday's trading session. Thanks so much for being with us.